This is the Capital Markets. Good evening and welcome to the program. I'm Edidi Onyiwang. It's been an eventful last week of January, from companies listing, releasing their economic outlook for the year, and to earnings releases and Lagos State's 100 billion naira infrastructure bond. Well, that's where we begin the show today. The Lagos State government has issued a 100 billion naira Series 3 bond under its 500 billion bond issuance program. The state governor, Babajide Sanwo-Olu, who made this known at the Deloitte 2020 Economic Outlook in Lagos, says the bond, which was offered through book building, recorded an oversubscription of 196.5%. He explained that the proceeds from the bond will be used to execute key infrastructure projects in the state.
We were pretty much lucky at the time in which we went to the market. So we started the conversation around October, and we knew we needed to be very smart, to be able to use the 2018 financials, right? And the Honorable Minister, who I must say that she deserves a round of applause, she gave us all the support to make that investment happen. So two things happened, right? We needed to get some approvals from her for us to be able to still play around our ratios, and they were very transparent ratios, and she gave us those approvals and those extensions. And so the second part of our luck was that we entered the market at a time where the market was actually very soft. Towards the end of the year, right, investors were looking for what are the investable instruments to put their money, and our bonds, just spring out at that critical time. So not only did we raise that amount of money, we're also able to clean up our balance sheet. The entire borrowing of Lagos State, we're able to reprice all of them, and from the savings we're looking at, we actually can save about 15 billion, in the next year or so, based on the creativity that we've been able to do. And that, I say, is the first subnational, sub-sovereign volume of bond for 10 years, at a rate that is pretty interesting that we have. So we want to thank you, Honorable Minister, and all of our investors. Some of them are in this room. I want to thank you very much and to say that you have put good money in good business. And so what are we going to do? We just signed a budget. I cannot compete with federal, certainly, of a little over a billion naira. A trillion naira, 1.16 trillion, right? That's the biggest audacious budget of the Lagos State. And in that budget, we're meant to be doing about 64% capital and about 38%, 36, 37% recurring, right? Recurring, we just also signed a minimum wage in which we'll be paying 35,000 and above to over 160,000, public officers, understanding that the cost of living in Lagos is certainly higher than comparing other parts of the country. So we said to ourselves, if other parts of the country can pay 30,000, there should be a premium, given all of the challenges that comes with staying in Lagos. So we looked at that, and we're also helping them to also meet their insurance policy, right? So in all of that, we're also ensuring that all our civil servants can be part of our insurance, our health insurance policy. So all of that is factored in. But in terms of infrastructure specific, so in that budget, we're believing that, especially with the bond that we've just raised, we're believing that we can clearly have a corrective narrative about what are the things we need to do in our team's agenda, but more importantly, in infrastructure. So you'll see constructions in roads, in bridges, new schools, new hospitals, water and sanitation, drainage lines, and these are all the major critical infrastructure that we'll be doing. Of course, housing will be an enabler, whereas the like of DG Ali, will put further investment there. We believe that in housing we can be an enabler, in that. But specifically, what are the things that you Lagosians must be expecting, for us? We're finalizing a procurement around a regional road. The regional road is a 9.3-kilometer road from somewhere off VGC and into busting out by the end of Freedom Road, right? So this is meant to be a toll road at the end of the day. It passes through water, right, and land. And you've seen we've started doing some people that are built on our right-of-way, and we're going to take them out because that road is critical. It's critical for two things. One, it relieves the Lekki-Ekpe Express Road, which in itself is at level 7, is at the highest level. That's one. Secondly, it also helps enhance traffic for the 4th Mainland Bridge that we've started the procurement for. So we're doing that road. We're also doing a couple of bridges. There's a bridge that we need to complete, which we call the Penn Cinema. There's another design for another bridge, which is supposed to come from Okpebi Link and hit somewhere around Maryland. There are 2-3 other roads that are not in areas where a lot of you here will know. There's a road called Ijagemo Ijedodo, Ijegu Road, right? It is on the western part of Lagos. It's a 7.6 kilometer road. Yes, I know you will never hear of those things, but they are critical roads. They are critical roads for that arm of Lagos, right? It's going to be joining about 6 communities together.
Meantime, the Managing Director and Chief Executive Officer of the Nigeria Sovereign Investment Authority, Uche Oji, says infrastructure financing requires innovative and bold thinking. Mr. Oji, who was also speaking at the Deloitte Economic Outlook 2020, advises the government to consider the tenor of bonds issued.
Infrastructure financing requires us to think innovatively, think big, and think bold. 100 billion naira bond helps restructure the entire financing, which I think makes a lot of sense. But I also would like us to think about longer tenured bonds. Argentina is a broke country, and yet they managed to do a 100-year bond. So I think we need to be able to think a little bit more aggressively about how we look at the tenure of the bonds that we issue. And also, innovatively, the tax credit is a wonderful thing. If you think about privatization, infrastructure, PPPs, all of these are buzzwords of the last less than 30 years in some cases, which means there's still a lot of innovation that can still happen. It didn't exist 30 years ago. It was innovated. And so to that extent, we've in NSI started to think a little bit more creatively about many things, about how we can mobilize capital both locally and internationally, but largely locally. If you think about local capital available, there's a lot of work we're now doing in that area. So let me speak to 3 or 4 things. Infrastructure. Earlier this last year, the NSIA changed its capital allocation strategy from 40% to infrastructure to 50% to infrastructure. And that may sound like a small move, but it's quite significant. And it's significant because the second part of our strategy is now to mobilize 4 times the capital that we invest into infrastructure.
Well, as part of its initiative to promote Nigeria's capital market, the Nigerian Stock Exchange launches Growth Board for high-growth companies. According to the NSE, the Growth Board is designed to encourage the listing of growth companies and provide a cost-effective platform to raise the capital needed to scale and put in place a regulatory structure that fosters growth. Let's take a listen.
The economic landscape in recent years has been quite challenging for corporates, with small and medium-scale enterprises experiencing some of the difficulties observed in the Nigerian macro landscape. These companies have seen declining productivity rates, largely caused by deficiencies in power supply, substandard trade facilitation infrastructure, lack of right-sized and right-priced financing, multiplicity of taxes, levies, and fees, limited availability of requisite talent, and so on. This is further compounded with an absence of needed corporate governance to ensure maximized capacity utilization and profitability for these companies. In spite of the challenges faced by operators in the SME space, this sector of the economy continues to show progress and innovation. It is noteworthy to mention that the African tech space has seen a significant increase in the funding of startups in recent years. In 2019, the number of investors, largely institutional, increased from the previous year by 61% to 261, and funding rose by 47% to $491.6 million, which was received by 311 companies. Excuse me. Nigeria remains one of the lead markets in terms of total funding, securing $122 million. We have also witnessed increased support from multilateral organizations and government agencies. For instance, to promote funding for African SMEs, the African Export-Import Bank, AfrExim, signed an agreement with the African Guarantee Fund, AGF, for a $30 million re-guarantee facility to support African small and medium enterprises in December of 2018. Additionally, the Central Bank of Nigeria, in collaboration with the Bankers Committee, also commenced the disbursement of 26 billion naira to MSMEs under the Agribusiness Small and Medium Enterprise Investment Scheme in 2018. From a growth perspective, Nigeria also has the single largest representation with 97 companies featured in the 2019 Companies to Inspire Africa report, jointly produced by the London Stock Exchange and PwC Africa. This report featured 360 growth companies across 32 countries in Africa, with 7 major sectors represented. The high representation by Nigerian growth companies clearly emphasizes the enormous opportunities present in the segment and the nation at large. In line with the exchange's focus and drive to deepen the Nigerian capital market and its support for startups and small and medium enterprises, I am pleased to unveil to you today the Nigerian Stock Exchange Growth Board. The Growth Board aims to encourage companies with high growth potential to seize the opportunity of raising long-term capital and promote liquidity in the trading of their shares. The board also presents as an avenue for companies in their growth phase to leverage the NSE's platform and varied products and services to achieve their long-term business objectives. This board is designed to offer relaxed entry criteria as well as less stringent ongoing listing requirements and allows for greater accessibility to capital flows, global visibility, and credibility through corporate disclosures. The Growth Board also restructures current market segments to better meet needs along companies' entire life cycle. That is the entry segment for companies with a market capitalization from 50 million naira and standard market for institutions with a market capitalization from 500 million naira.
Well, let's take a quick look at some of the earnings released by listed companies. Fidelity Bank's unaudited financial reports for the period ended December 31st, 2019 showed the company's gross earnings rose 15% to 217.3 billion naira. Net interest income for the period under review grew by 12% to 82.1 billion naira compared to 2018 73.3 billion naira. Profit before income tax stood at 32.3 billion naira, indicating an increase of 29%, while profit after tax grew by 28.5% to 29.5 billion naira. Well, FCMB's group's full year 2019 financials also shows a 5.3% increase in gross earnings to 186.68 billion naira from 177.24 billion naira in 2018. The group's net interest income grew by 6.5% to 77.28 billion naira. However, profit before tax fell 24.1% to 20 billion naira, while profit after tax dropped 22.5% to 17.72 billion naira. Well, Sterling Bank's unaudited financial reports for the period ended December 31st, 2019 shows the bank's gross earnings rose 1.3% to 154.08 billion naira. Net interest income for the period rose 17.4% to 64.89 billion naira from 55.28 billion naira recorded in 2018. Pre-tax profit grew 15% to 10.01 billion naira, while post-tax profit grew 17.2% to 10.80 billion naira. We'll take a quick break. When we return, we'll take a listen to some market economic outlooks for the year 2020. Stay with us. Welcome back and thanks for staying with us on the program. Maritime Securities has listed portfolio inflows from the money market as one of the market drivers this year. A senior investment research analyst at Maritime Securities, Ahmed Jinad, who was speaking at the company's annual economic outlook launch, says foreign participation in the market will remain weak due to macroeconomic conditions.
Portfolio inflows from the money market. So, we are talking about home maturities from domestic investors, non-bank corporates that will not be reinvested in the home market. Some of these we are already seeing them spill into the equities markets. January has been a green one for everyone. So portfolio inflows from the money market, and also because of the lower yields in the fixed income space, as well as the fact that already we are seeing some results, and so earnings season and declaration of dividends, and because valuations too have gone low, it now means that dividend yields have become very, very attractive. So we expect this to drive the market at least through the first quarter of the year. The hunt for dividends also, especially for people who value dividend stocks. Foreign participation in the market, we expect it to remain weak, and this is not because of the equities market in itself. It speaks more to the macroeconomic condition. Growth remains weak, and we are seeing a lot of policies, unconventional policies. While for us it is easy to adjust to these policies, for foreign investors, it raises the risk profile and spooks foreign participation in the market. And that too is if you ask me, I'll say it's a positive. So we have what has been driving the market this year has been domestic investors. And so they will not be quick to sell off like we've had foreign portfolio investors do in the past 18 months. So that too should boost the performance of the market in 2020. So backing nothing on fundamentally sound stocks, while corporate earnings growth from our analysis, especially for industrial goods, the banking sector, and all other sectors, from the drivers that we've considered, corporate earnings growth will remain weak. For us, we are forecasting the market to gain 10.27% in 2020, and we use different approaches, fundamental approach, econometric method, as well as neural networks to arrive at these forecasts. We are seeing strong demand for corporate issues as investors seek higher yield. Of course, because of the lower yield environment as well, debt refinancing, as well as the issuance of new debt instruments. This will also lead into innovative and alternative investment products in the near term, as well as the high possibility of a Eurobond issue. But of course, corporate Eurobonds are not attractive at this time. Okay, yeah, so for fixed income strategy, we are saying that concentrate exposure on the mid to long tenor instruments in the T-bills market. We favor bonds with higher tenor at the long end of the curve that have attractive yields, and we are also recommending that we take advantage of investment grade commercial papers that will inevitably come to the market in 2020.
Meantime, investment advisory firm Chapel Hill Denham expects a repricing of yields on both the long and short end of the curve in the second half of 2020. Well, that's according to a macro and fixed income analyst at Chapel Hill Denham, Omotola Abimbola, who was speaking on the company's market outlook for 2020 on our Business Morning program.
If we look at the Naira from a fundamental perspective, the currency is already moving outside the range of fair value. So we like to look at the fundamental pricing of the currency based on the long-run, real effective exchange rates, index. And we discovered that currently the currency in the official market, at least, is trading at about 1.1 percent standard deviation above the long run mean. And so that implies that the fair value of the currency should be between 380 and 400 naira. But of course, as we know, for the outlook for the currency market, it is not just a case of looking at the fundamental analysis alone, but also looking at two critical things. Number one, the willingness of the central bank to defend the FX peg and their capacity to defend the peg. And currently, there is a will to continue to, defend the currency peg at around the currency de facto peg, to continue to defend that de facto peg at around 360 to 365 naira, as we can see. So late last year, we saw a bit of pressure in the currency markets coming from, increased capital outflows. But the CBN continued to intervene aggressively in the currency markets to ensure that we have stable exchange rate. We also have a bond maturity, coming in February, about 600 billion naira. But in the second half of the year, and even if I might say, early into Q2, we expect to see a marginal repricing, in fixed income yields.
Okay, so
that repricing will be anchored on three major things.
Omotola, quick one. Is this repricing not already happening? Some folks believe that this repricing is already is beginning to happen right now. If you look at the secondary trading of both open market operations and NTB, do you think it's already beginning to happen? We're looking at some NTBs here at around 8%. Yes. Please go ahead. Yes. Just looking at the numbers.
That's correct, Bossing. We are seeing a repricing in the treasury bills markets, but we haven't seen that filter into the bond market because of the fundamental issue of shortage of supply of FGM bonds that will likely occur into the second half of the year, largely because of the guidance by the DMO that the federal government will be looking to raise more funds externally. So the current repricing we are seeing is still mainly in the treasury bill scene. We haven't seen a similar thing occur in the bond market. But in the second half of the year, and even late into Q1 and early Q2 2020, we're expecting the repricing to take place both at the short and the long end of the curve. And as I was, discussing initially, that repricing will be anchored on three principal things. So the first thing is that Nigeria is in need of increased external financing to support the currency. So we are seeing current account deficits, widening to 2.8% of GDP in the year, primarily because the CBN is trying to push more lending to the private sector. And if you're trying to grow lending to the economy, that will lead to increased importation, of machineries, of raw materials, etc., further putting pressure on the current account. So there's a 2.8% of GDP deficit to fund in the current account. And there are three principal ways to fund that deficit. You could, take advantage of, foreign direct investments inflow, foreign portfolio inflows or external reserves. But Nigeria's foreign direct investment is very, very low, at just about 0.5% of GDP. So there's still a need for more portfolio inflows to fund the deficits in the current account. So that could potentially lead to the CBN trying to tighten liquidity, much later in the year. And if I can take you back to what occurred at the MPC meeting last week, where we had a very surprising hike in the cash reserve requirements. So that more or less signals that the CBN is also very wary of this liquidity. And as the year, moves on, they'll be, looking at alternative measures, not excluding CRR, to actually try to tighten that liquidity in the financial in the financial markets.
Well, that's all on the program tonight. Thank you for watching. I'm Edidion Iwang. See you next week.